Welcome to International Finance video number 2. So far we have discussed international financial market and its segment, foreign exchange market features, and the division of foreign exchange market, that is spot market and forward market. Now we are going to discuss an important topic from this area, that is risks in international transactions. All of us know what is business risk. It implies the possibility of some unfavorable happening. In a layman's language, we can say it is the possibility of loss due to some uncertain future event. International business risk is also the possibility of loss caused by some unfavorable or undesirable event in international business operations. There are many risks in investing and financing decisions involving foreign currencies. There may be changes in the international environment, difference in the economic system, and cultures of different countries. These are the main causes of international business risk. So the degree of such risk, it differs from one company to another company and from one country to another country. Okay. So we can classify these risks into two major heads, that is currency risk and country risk. First classification is currency risk. There are two important currency risks. They are exchange risk and inflation risk. First one is exchange rate risk, or we can call it as foreign exchange or forex risk. Actually, it is unavoidable risk of foreign investment. Actually, this risk is caused by the fluctuations in the investor's local currency compared to the foreign investment currency. Okay, you know the fact that the exchange rates are volatile. This volatility or variability in the exchange rate is called as exchange rate risk. So it is a kind of risk that exists when a financial transaction is denominated in a currency other than the domestic currency of the company. Actually, what happens here is that before the financial transaction is completed, there is a change. There is a change in the exchange rate between the domestic currency and the denominated currency. Okay, it may be an unfavorable change. So we can say there is always a risk of an unfavorable change in exchange rate between the domestic currency and the denominated currency. Okay. And normally investors and businesses exporting and importing goods and services or making foreign investments have an exchange rate risk. Okay. Next is inflation risk. What is inflation? Inflation is the general increase in prices and fall in the purchasing value of money, right? Inflation is an economic term that refers to a situation of rising prices of goods and services within a particular economy. Generally, when prices rise, what happens? The purchasing power of consumers decreases, right? For example, prices of many consumer goods are double that of 20 years ago. In simple sense, we can say inflation refers to the rise in prices of goods and services of daily common use, such as food, clothing, housing, etc. Due to inflation, the purchasing power of a currency unit decreases. Subsequently, it impacts the cost of living in a country. That is, when inflation is high, the cost of living gets higher, which ultimately hamper the economic growth. So, inflation risk, also called purchasing power risk. There are some important points to note. Actually, some experts say that there is two types of inflation, that is demand pull inflation and cost push inflation. If inflation happens due to the rise in demand, it is called demand pull inflation. And if inflation happens due to the rise in cost, it is called cost push inflation. Actually, these are the causes of inflation. When we analyze the main types of inflation, we can see there are four classifications. First one, walking inflation. Second, creeping or mild inflation. Third one, galloping inflation. And lastly, hyperinflation. Inflation is when the price of goods and services increase, right? Then what is deflation? That is just opposite of inflation. That is a general decrease in prices and an increase in the purchasing value of money. And what is stagflation? That is inflation plus slow economic growth. that is inflation plus a declining economic growth, that is termed as stagflation. These are some of the important terms relating to inflation. That's why I just mentioned, okay. And last one is hyperinflation, that is extremely high and fast increase in inflation is termed as hyperinflation. Okay, let's come to the point. We are covering 4 basic types of inflation, right? So first one is creeping inflation or a mild inflation. It happens when prices rise 3% or less in a year. According to Federal Reserve, when price increase 2% or less, it benefits the economic growth. You will be thinking how it's possible. That is, when mild inflation happens, the consumers will think that prices will keep going up. They expect a higher price in future. So actually what happens is consumers buy now to beat higher future prices. So naturally there will be a rise in demand. So a mild inflation drives economic expansion. Okay. Second is walking inflation. When price rise is between 3 to 10% a year, it is called walking inflation. This type of inflation is harmful to the society. Next is galloping inflation. When price rise is greater than 10%, it is termed as galloping inflation. This is actually a destructive type of inflation. Foreign investors avoid the country and economy becomes unstable. Government leaders lose credibility. And last one is hyperinflation. This happens when the prices rise greater than 50% a month. So these are the basic types of inflation. First one, creeping or mild inflation, and then walking inflation, then galloping inflation, lastly hyperinflation. We are covering risks in international transactions. There are 2 classifications, currency risk and country risk. And currency risk involve exchange risk and inflation risk. We have seen what is exchange risk. We have also seen the different types of inflation risk. Okay. So the next point is country risk. It involves first one political risk, second one counterparty risk, and third one liquidity risk. What do you mean by country risk? It refers to the uncertainty associated with investing in a particular country. This uncertainty happens because of a number of factors, maybe because of political factors, economic, and maybe because of exchange rate or technological influences. The first category coming under the country risk is political risk. What is political risk? It is the risk an investment's return could suffer as a result of political changes or instability in a country. That is any kind of instability which will affect the investment returns. It could arise from a change in government, legislative bodies, etc. It's also known as geopolitical risk, and it is also considered a type of jurisdiction risk. We can say an example for political risk, that is there may be a variety of decisions taken by the government which will affect individual business, industries, and consequently the overall economy. Okay, so these type of decisions include taxes, regulations, and about currency valuation, trade tariffs, labor law, such as minimum wage, and of course environmental regulations. These decisions may have favorable or unfavorable effect on the business. This type of risk is termed as political risk. Okay. Second category is counterparty risk. This type of risk happens when one of the parties to the contract will not fulfill his contractual obligations. That is, it is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. This counterparty risk, also known as default risk. In simple words, we can say that default risk or counterparty risk is the chance that companies or individuals will be unable to make the required payments on their debt obligations. Okay, clear? Last one is liquidity risk. What is liquidity? It is the ability of a firm or even an individual to pay its debts without suffering tragic losses, that is terrible losses. That means if an individual investor or business or financial institution cannot meet its short-term debt obligations we can say that it is experiencing liquidity risk. Okay, in other words, we can say that liquidity risk is the lack of marketability of an investment. So these are the three kinds of risk, that is, so far we have discussed political risk, counterparty risk and liquidity risk. So these are the three kinds of risk coming under country risk. Okay, so far we have discussed two major types of risk which is involved in international transactions. First one, currency risk, and second one, country risk. Currency risk involves two types of risk, that is exchange risk and inflation risk. And again, country risk can be classified into political risk, counterparty risk and liquidity risk. That's all for this video. Thank you for watching.